Hello, in this lecture, we're going to talk about the definition of accrued revenue. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of accrued revenues is revenues earned in a period that are both unrecorded and not yet received in cash or other assets. Adjusting entries for recording accrued revenues involve increasing assets and increasing revenues. Let's break this down a bit. Accrued revenues means that we have earned the revenue. So we have done the work. When do we earn revenue under the revenue recognition principle? When we do the work. So we've done the work, we've earned the revenue, but it has not yet been recorded. We haven't recorded it in our books. There's been no journal entry related to it, and we have not received compensation. That compensation usually being in the form of cash, but obviously we could receive something other than cash, such as other types of assets in a barter system for compensation. Typically what this would mean is that we did work and we have not yet recorded the entry for the work. That normal entry would be a debit to accounts receivable and a credit to revenue. Therefore, we would need to do an adjusting entry as of the cutoff date. So this would be a form of adjusting entry that we would need to adjust for, and the adjusting entry would then record the revenue and record the related assets. So let's take a look at an example of this. We have an owner over here on the left-hand side, a customer on the right-hand side. We're going to say the owner is a lawyer or provides legal services. And let's imagine that the legal services happened on 12/22. That's when the job was done. Job was done. Money was earned under the revenue recognition principle at that time. But under a legal service, we need to basically collect all the data on how many people on our staff worked on this job and then send out the invoice. The invoice may not have gone out till January. And if our cutoff date then is the 12/31 cutoff date, that means that we did the process correctly. We sent out the invoice and we recorded the journal entry properly at that time, debiting accounts receivable, crediting revenue over here at the invoice date. But the invoice date isn't always actually the date we did the work. In this case, we did the work before year end. We actually provided the legal services here. The invoice went out after year end just because of paperwork and us having to put the data together. If we're making the financial statements as of 12/31, we need that revenue related to this job that was done in this period to be included in the income statement for this time period. Therefore, we're going to basically pull that income in the adjusting entry process for the accrued revenue, and therefore the adjusting entries in this case is going to debit accounts receivable and credit revenue for the time period of 12/31 to get it into the financial statements as of 12/31. Then, of course, we would have to reverse it so that we don't double up the journal entry, because we did record the journal entry. It's just that the timing was after the cutoff date.